Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 13th of 2024. Getting started this week, let's talk about economic growth and where we look heading into the latter stages of the second quarter here. First quarter, as we know, we had a real GDP of 1.6% there in the first quarter for the 3 months ended March 31st. And this is taking a look at the second quarter. And so we have the Atlanta Fed and their GDP now estimate on the left-hand side. You can see here in that green line, you can see where they're kind of arriving at. And it's about 4.2%, which by all accounts would be a fantastic quarter. Certainly wouldn't be symptomatic of a slowdown. So, it may very well be, if this turns out to be the case, that the soft landing has already been achieved in some measure in some respects, but not all the data is necessarily superb right now. We do see slowing in the labor market, and I do think we have maybe a few headwinds on the horizon for consumer spending. We'll take a look at consumer credit is moving higher, but you can see just about every phase of the equation. Again, CIGX is the formula for economic growth. That's consumption, investment, government spending, and net foreign exchange. And so when you get all of those things aligned in terms of the estimates on the right-hand side here, you can see that black line represents where the Atlanta Fed is on their estimate for second quarter, again, 4.2%. You can see government spending is positive. You've got consumption that's still positive. That's the PCE goods expenditures. And then you've got the light blue, which is PCE services expenditures, and those are both positive and expected to be additive for the quarter. And then you also have investment, which is expected to be positive, kind of offset slightly by net exports, which was also a culprit there in the first quarter, number being a little bit lower. So here we are, looking at the first quarter. We're going to get at least two more revisions on the first quarter number. Again, that was lighter, but second quarter expected to be much, much stronger in terms of overall economic growth. And you can see here on the left-hand side that shaded blue chip consensus. Most of the estimates are still well below where the Atlanta Fed is. And I'll just add this for color, is that Atlanta Fed has actually done a really good job of forecasting overall economic growth over the last several years. And here we have a summary of transcripts from S&P 500 companies and their earnings reports, mentioning the word recession. And you can see that word count continues to trail down. Again, the recession was all of the rave and all of the expectation, as we were certainly heading into 22, we know was a tough time, and everyone was expecting it to happen in 23. It didn't happen, and here we are in 2024. We haven't had a recession yet, and as we just saw in that last chart, we don't appear anywhere close to a negative economic growth circumstance. And here we have the payroll number that's usually released here on the first Friday of the new month. And for April, we had 175,000 jobs. You can see that was a little bit lighter than what we've experienced over the last handful of months. But, when you look at it over the long haul, it seems to be fairly well in line. What it does is kind of show you that maybe, there's not a lot of froth in the labor market. I think labor is still somewhat tight. You see the participation rates still remain a little bit sluggish, particularly amongst the older cohorts, but you do see quit rates kind of settling in. Obviously, we have wage inflation, and real wages are still positive, and there still is some mobility for workers in being able to move in between jobs. But, we do see the overall payroll number softening up a little bit, which, again, I take as a positive here. Continuing the labor discussion, here we have the unemployment rate. You can see in April with the number, we got the 175,000 jobs, which is lighter. We also had a corresponding slight uptick in the unemployment rate to 3.9. You can still see that that's below 4. and we're still within striking distance of our low reading since 1969. So labor, again, remains tight. It's a little bit softer than it was maybe 6 months ago, but it's still relatively strong. It's kind of like evidence of maybe some settling in here. I think jobs are neither tight, particularly tight, nor particularly plentiful. Again, just like on that last slide, I take this as healthy. Now, I don't expect necessarily, barring a recession, that unemployment is going to go to like 5.5%. But if it meanders here between like 3.8 and 4.1, I think that that's entirely healthy given the circumstances. Something else I thought was pretty interesting in the latest round of earnings calls. Again, we are kind of like towards the kind of the latter stages of earnings season here for first quarter, and so it's a good time to take stock. Obviously, we just saw a few slides ago that the recession mentions continue to go down, but also we see artificial intelligence mentions continue to move higher. And I think the real boost to productivity, which is one of those things that helps to keep inflation low, is going to be not just the AI itself, but how it's applied into business processes. And I've been listening to a lot of conversation and interviews of people that are much more in the know on these things here over the last couple of weeks. And they're saying that kind of implementation phase of AI is going to be happening over the next couple of years. And so, again, if we avoid this downturn, and if we have literally already seen this soft landing, if you will, I think there's a case to be made that there's a lot of sustainability in the next economic cycle, partly because of not just the AI itself, but how it's implemented into business processes. We have another chart on labor here. We've got initial jobless claims in the black. There you can see that kind of meanders around a bound there, and claims picked up at the same time that new jobs was a little bit soft last month. Not really anything for me to worry about at this juncture. You see continuing claims settling in, if not ticking a little bit lower. Again, I think signs of a fairly healthy labor market. Got the Citigroup Economic Surprise Index ticking lower here as of late. That has been largely positive for the balance of this year. So when you get into a stretch, this is kind of the law of numbers, if you will, that when you get into a stretch of outsized numbers relative to the year ago when the anniversary data and that new data is really strong, when you get to that next year, it's going to be hard to anniversary that data. Meaning that when you have a really strong number the year prior, you've got to do that much better this year to have a really strong number. And the surprise number here, some of those estimates were being ratcheted up quite a bit when they probably should have been tempered a little bit. And so what we're seeing here is just kind of I kind of term it as like the law of numbers, we've had some pretty strong data, and so data recently has not necessarily been bad, but it just has fallen a little bit short of expectations. Here we have credit card spending. What's really interesting here, we continue to see those balances rise. We continue to see interest rates remain very, very high on credit cards. And we also see delinquencies move higher too. So we're monitoring that. And the rhetorical question is, well, at what point do default rates and non-performing balances become a problem? And that's a little hard to determine right now. We've got card spending across all categories. Here, we've got services and restaurants really moving higher. Of course, services lagged the recovery post-pandemic, and we did see goods spending really spike here. So here we've got the upper half of this chart. You've got service spending really strong. You have total spending still positive. Retail ex restaurants. Maybe from a pure index standpoint, maybe a little softer than it was, but back in 2022, we had a lot of spending growth, And then Exhibit 2 down there below shows you by income cohort. And you can see here that lower income folks were spending more on their cards, and that growth was a lot stronger than the upper income cohorts, although they all continue to move higher. We have gold prices continuing to remain really strong. What's interesting here is, gold typically serves as an inflation hedge, but you have some other kind of like financial demand drivers. You have demand for physical gold for other things, and that can also be a little bit cyclical too. But when you look at it across the foreign spectrum, there's just a lot of drivers for gold right now, not the least of which is a strong dollar, higher interest rates, and sticky inflation. But gold still very much near its high here. Then we've got U.S. stocks relative to China. Why is this important? Well, China still is surprisingly, even as the second largest economy in the world, is still deemed an emerging market. And so, how it relates to the attractiveness of the whole EM space, China certainly is relevant to the global sphere. And honestly, over the last decade, China has accounted for I wouldn't say the majority, but a significant portion of overall global growth. But you see here, just from a price standpoint, both on the equity and the fixed income side, that U.S. stocks are priced extremely at an extreme premium relative to Chinese stocks. You can see that here very clearly in this research from Bank of America Global Investment Strategy from their team. And then similarly on treasuries, you can see that U.S. treasuries are really at an all-time delta relative to Chinese government bond returns. And so, the attractiveness of China is certainly there. It just really lacks a catalyst. And there's some systemic issues related to China, not just the demographic one, but, it's not a consumption-led economy, and their economic growth is predicated on export volumes, and they don't have enough consumption internally to satisfy all of this new production that's been put online. And so therein lies the issue with like EVs and some of the rhetoric this week about putting new tariffs on EVs by the Biden administration as a way to forestall some of the dumping that China is doing, because they have this excess manufacturing capacity and they can't support the consumption internally. All right, so with all that being said, we've got the expectation for Fed interest rate moves, and and we've talked ad nauseum about how the kind of the froth on all of that's been taken off from the end of last year, and we're not going to have 6 rate hikes. Honestly, there's some people that are trying to make a case for another rate hike, and I don't see that necessarily. You do have restrictive rates now because short-term rates are higher than the rate of inflation. So that by definition means that rates are restrictive. And so currently the estimate is for 1, maybe 2 rate hikes this year. And again, we're getting closer to the middle of the year, so puts a lot of pressure on those handful of meetings. And just to recap, the Fed meets every 6 weeks, and so when you think about that, how many times they have left to meet, once you get to like June, I think there's a strong, perhaps a stronger case to be made that interest rates aren't going to move at all. I think what's going to make interest rates, I think probably go down is if you see some erosion in the labor market, which, as I said, remains fairly strong. You might see rate decreases if you see some credit erosion, and credit spreads on fixed income are really, really tight. So there's absolutely no fear of a credit problem out there in the bond markets. You do see some credit issues, some banks that are, kind of increasing their reserves against non-performing loans. And just as I mentioned, you've got credit card balances and some of the delinquencies there are beginning to rise, but it's not at a crisis situation yet. And I think if you saw that erode a little bit further, I think it would probably give a little bit more cover for the Fed to do that. But wages, real wages, remain sticky, and eventually we'll see the rent, owner's equivalent rent and CPI begin to trend down, and I think that at some point will give the Fed cover to reduce rates, but right now the estimate is for 1, maybe 2 rate cuts by the end of the year. So here we have some data on the Fed rate cut issue, and we are tracking a fairly strong gap between the date of the last rate hike and the first rate cut. And obviously we haven't had a cut yet. And, you can see here that we're about 300 calendar days out from the date of the last rate hike. And so, and just as we saw on that last slide, I think the prospects for a rate cut maybe a little bit questionable, near term. I think rate cuts are on the horizon, perhaps, but it doesn't look like it's going to happen over the next several months. So, as you can see here, going back to 1996, that gap is apt to only get longer, and we could actually eclipse the duration that was set back in 2008 of roughly about 450 days. So that may be something that we'll be monitoring. And you can see here on the right-hand side, this is also, I think, relevant to investments and positioning and things like that heading into the middle of the year, that by and large, when you have, this gap that we're talking about here, that the S&P 500 actually does relatively well, and you can see these different periods like in between, or I guess I'll call them inflection points in Fed rate tightening cycles going back all the way to May of 1974. And with some exception, the S&P 500 actually does pretty well. So there is case history here to support continuing relative performance on the part of equities. See in this chart from S&P, this is from Crossit Capital, a research piece I thought was pretty interesting here. So you've got price return of the S&P equal weighted index, and then you also have, and that's in blue, and then the amber line represents earnings and dividend returns. And you can see that basically the equal weighted index has tracked, going back to 2010, basically tracked earnings and dividends. And I'd say primarily, estimated earnings had much more of a determinant on overall performance of the equal weight. Now we do know that the all-in or the market capitalization weighted, which favors the very, very, very large firms, tends to be driven a lot more by multiple expansion and kind of momentum. But here on the equal weight side, you can see that earnings are the main driver. There's a chart here that I thought was also interesting coming out of the latest quarterly earnings results, and what we see here, in data going back to the first quarter of 2017. The interesting thing is when companies beat the estimate, they tend to get a lot less love than the pain that they get when they miss. And you can see that here very clearly delineated by the amber bars going down are much greater than the blue bars going up. And so, if you're a company that, that is doing exceptionally well right now, you're just, history being the judge, and particularly over in the far right, you can see 1Q of 24, that, certainly relative to some of these other periods, you're just not getting rewarded for it, but you sure are getting hammered if you miss it. We talk about fund flows into the fixed income market. And I told you that credit spreads are really tight. And what does that mean? That just means that there's very little fear of a credit quality problem, meaning that credit is expected to remain relatively strong. And as a result, you've seen a lot of optimism and fund flows that kind of reflect that optimism. And here on the left-hand side, you have investment grade money flows into these areas remaining very, very strong. In fact, if we were to end the year today, those fund flows would be on pace for a record. And then on the right-hand side, you see bank loan funds here also witnessing strong inflows, and that's a sign of significant confidence in the lower quality tiers of the fixed income market. Here we have borrowers' ability to pay for debts. So this is one of those things, again, in every chart pack, there's puts and takes, and this is the one that makes you scratch your head and think, well, why is everyone so optimistic? The way this is calculated, though, is I think is tad misleading, and I'll tell you why. So this line represents essentially interest coverage. So it takes earnings before interest, taxes, depreciation, and amortization, or what is known as EBITDA, and it subtracts out capital expenditures and taxes, cash taxes, and then it divides that by the interest expense and whatever debt repayment you have. What it doesn't include is the interest income that you're earning on your treasury balances, and so we know that those are a lot higher. So when you include that, this chart doesn't look nearly as bad, but on its face, it is something that you pay attention to, that interest coverage, excluding the benefit of interest income on outstanding invested balances, it is in decline. And so, to the extent that the rates remain higher for longer, that helps the interest coverage situation. And if rates were to go down significantly, the earned interest on those balances would decrease, and then this would become a little bit more of an issue. Something else I've been monitoring that I think is really interesting to the overall backdrop is the private equity space. And we do know that private capital, private debt, and equity, there's a lot of firms that have a lot of dry powder. They've been struggling to deploy some of it, and this is part of the reason why. I mean, you've got kind of a backlog of companies that are still portfolio companies to these PE and private debt firms, and they're not able to IPO, they're not able to be sold, so they remain in inventory. They continue to grow. But the whole PE model is predicated on being able to engineer those exits, and they exit, they take those proceeds, they reinvest in new company investment, and so on and so forth. And so you have a lot of PE funds that are actually pretty flush with capital right now, but they're having a hard time deploying it because a lot of the market is really just kind of tight and bogged down right now. In the PE, in the PC, in the private equity exit space. We have sentiment. We show you from time to time American Association of Individual Investors, your bull-bear spread. When things are moving up above that midline, that represents optimistic times, and that's clearly where we are now here in 2024, with a little bit of exception, but things are pretty optimistic from an individual investor standpoint. We have an overlay of the forward 12-month PE ratio, price to earnings ratio. That's in the black. And then we have the forward 12-month PE ratio for the equal weighted index. And like I said before, there is a difference, and there is a pretty wide gap right now. So when you look at that kind of, I'll call it purple line there, you've got the equal weighted index based on forward 12-month earnings is right around 17 times earnings. And that's really not that far from the long-term average. Now on the black line there, you see it's about 20.5, and so it's actually going back up and remains relatively high here in 2024. And therein lies the gap. So that's the forward earnings estimates for the call it the very large companies that heavily influence the market capitalization S&P 500. The market capitalization weighted S&P 500 are clearly driving those valuations higher than what would ordinarily be the case just looking at the equal weight. Here we have the S&P 500 two-year forward PE ratio. And so this is different. This is like looking at earnings 2 years forward, not the 12 months forward that we were looking at in that last chart. And that's in the black line. So you can see that based on that number, the PE ratio is about 18 times. So not egregious, certainly not where it was, in 2020 and 2021. But it's obviously higher than than the multiple compression we saw in 2022. So that on its face is pretty healthy. But what's interesting here is that when you overlay that onto the TIPS 10-year TIPS yield, and that is the Treasury inflation protected security, and so the TIPS yield, what that represents is basically it's basically the 10-year Treasury rate minus the rate of inflation. And you can see that right now is about 2.2%. And if you look at the gap there, really one of two things is apt to happen. One, you're going to have rates move higher, or you're going to have the market kind of like trend lower, or valuations trend a little bit lower. And I think that these are probably going to meet somewhere in the middle, because I do think TIPS we're going to have higher rates for longer on the 10-year, but I do think inflation's coming down, so those TIPS yields should move higher. But I do think that multiples are a little bit challenged at this point. Most of the gain that we saw in 2023 was from multiple expansion. I think the pressure is going to be on earnings, much more so on earnings growth this year to achieve those continued stock gains. Okay. Now we're going to take a look at the S&P 500 forward 12-month price to earnings ratio relative to 10-year corporate bonds. And this is the 10-year BBB corporate bond yield. So BBB, all that means is that you're still dealing with investment grade corporate bonds. They're not AAA, but they're not junk either. And you can see that yield is indexed on the left-hand side of the scale, and then the PE ratio is on the right-hand side. And you can see here that, again, evidencing a gap here. So as we know, yields have moved higher. The BBB, 10-year BBB yield is getting closer to 6% here. It's above 5, but not quite 6 yet. But you can see the gap there on the far right between where that sits and where the forward PE is. And as we said, that's, basically around 21 times ish, approaching 22. And, generally that gap is a lot narrower. Kind of pivoting around a little bit here, looking at earnings revisions. And as I said, earnings are going to be paramount in the continuation of stock price expansion. And it looks like here that we've got global data, Bloomberg, TS Lombard, all involved in this data, that earnings revisions are moving higher. And again, that doesn't translate automatically into earnings expansion, but clearly the expectation based on the latest round of earnings calls from the Fortune 500 publicly traded firms would lead analysts to suggest that earnings are going to be higher. And so you see them revising their estimates up, and if this does hold and carry through to fruition, then that would obviously provide the feedstock for further stock price expansion. There we have the S&P 500 index. This is the earnings estimates for both the S&P 500 in black, and then in purple we've got the Russell 2000. And we know that in the Russell 2000 there's almost 35–40% of the companies just aren't profitable right now, which is an astounding figure. But when you look at earnings estimates for the Russell 2000, they're really kind of in the dumps. And you can see that very clearly, with that flat lining and that purple line, but you obviously see that the S&P 500 is moving higher. And so when you talk about the relative value attractiveness of small cap stocks, it is real, it is tangible. There is a huge gap, and large caps have done much better than small caps. But and there is a value proposition for small caps, but not that you should time it, but small stocks really do need a catalyst. I do think with overall earnings estimates moving higher for the S&P 500, and if the credit markets settle down and credit is a little bit easier to get, which it does appear like it's trending that way, and if in fact we have achieved a bit of a soft landing, and that the preponderance of economic growth is going to be better, i.e. the GDP now of estimate for the second quarter economic growth of 4.2%. If that plays out, then that may serve as the catalyst for earnings estimates growth on the part of small caps, and that would also serve as a catalyst in turn to expansion of increase in prices of small caps, and maybe even relative to large caps. So I think the catalyst may be on the horizon for small caps, but as we just look here, the estimates are clearly languishing a bit. We have volatility heading up to election. We do have a presidential election, which I fear is going to be ultra contentious, and a lot of people are in a bit of a quandary because there's kind of that silent middle that feels like they're not being represented by either of the primary presidential candidates likely to receive their party's nomination. But aside from that, the volatility tends to pick up. Now, the red dotted line there you see at the 0 represents the election, and so this is all indexed to 3 months prior to that. So obviously that's November. So you're dealing with, essentially August at that point. So, as we look into the early part of or the middle of the third quarter, I guess I should say, then typically you do see that volatility pick up, but then it peaks around the election and then it goes down. Now, we did actually see a bit of a real nice move back when Trump was first elected. And we did see markets respond rather positively with a decrease in overall volatility in that first election. It'd be interesting to see what plays out here, but clearly, I would be on guard for increased volatility in the coming 3 to 5 months. I thought I'd end the chart pack with this chart. We kind of talked about credit card usage before, and the balances moving higher, some of the delinquencies moving higher. And we looked at usage relative to income cohorts, so on and so forth. Here's a look by kind of like age cohort too. And what was interesting to me is like during the pandemic, that Gen Z cohort opened credit card accounts at a much faster rate than did millennials. And of course, millennials are kind of like transitioning into the earliest part of their peak earning years or decades, if you will. And they were a little bit more circumspect in opening accounts during the pandemic than the Gen Z crowd is. And I'm a student of near-term data, but I'm also a student of long-term potential trends. And so, if you believe that I don't necessarily yet believe this, but if you have Gen Zs that get in over their head with credit card debt, so on and so forth, and we're in a higher interest rate regime for longer, I clearly don't see us going down to the zero bound on short-term rates anytime soon. That it could mean that you get less consumption benefit from the Gen Z cohort because they're spending more to cover their credit card balances and they're living a little bit more profligate than maybe some of the other age cohorts are. I just thought this was interesting. It looks like there's, the credit card openings have trended down here, as you can see in this chart, and they tend to be correlating a lot better with the millennials. But again, I thought it was interesting, not worth fretting about at the moment, but is in the spirit of always wanted to look forward, like not just this year, next year, but like 5 to 10 years out. what could that look like for that rising generation? That's all we have for this week. Hope you've enjoyed the chart pack, and we'll look forward to seeing you again soon. All you mothers out there, have a wonderful Mother's Day. Thank you.